Hey everybody, Brett Rice with Core Vision Financial Group coming to you with another installation in our video series on financial topics. Hey, go to our YouTube page and subscribe so you're notified when we post a new video. Today we'll be joined by Brent Thoman, partner here at Core Vision, and Brent's going to talk about capital gains, realized, unrealized, and some of the situations that arise around those. So thanks for joining us, Brent.
Thanks, Brett. I appreciate you having me on here. Again, Brent Thoman, been with Core Vision since 2015 as a partner and been in the advisory business and financial industry for 25 years. Got into it with my father when I graduated in 1999. Yeah, today we're going to talk about capital gains. That's something that people talk about. It's probably a little bit more misunderstood because there's multiple ways. When is it taxable? When is it not taxable? And what does capital gains actually mean?
Sure. You hear people talk about capital gains and the concern over that, and it's super important. So we want to make sure we put out an educational piece that just helps people kind of understand what is a capital gain, what isn't, when is it realized, when is it not realized. So why don't you just walk us through, starting with that, what are capital gains?
Capital gains is when you have purchased, we'll go with stock. You purchase a stock for, let's say, $10 a share, and the market's been good, and at $15 a share, you decide to sell it. That $10 to $15, that's a $5 capital gain, meaning you've made money. So the difference is that $5 capital gain that you haven't sold is called an unrealized capital gain, right? When you go to sell it, the IRS says you're realizing that you're getting that as cash or whatever you're going to do with it is considered a realized capital gain. But really, capital gain just means you've made a profit on this stock, whether you've sold it or not sold it.
So it becomes realized when you sell it.
Correct. Realize, and that's why they use that. Realize, you're realizing the actual profit that you're making. If you let it sit and stay in that stock, it is unrealized because you have not realized anything. You've just seen it on paper going from $10 a share to $15 a share.
You've said that, hey, the IRS is going to see that and say, hey, now you got to pay taxes on that. Capital gains are taxed a little differently.
Yeah.
So why don't you touch base on that?
Yeah. Okay. So capital gains are different than income taxable. Let's talk a little bit about when it is actual taxable, right? So if you have what's called a non-retirement type of account, that could be just a stock that you have in your name. It could, a bank account could be a non-retirement account. That's when you're going to be taxed if you realize that by selling your stock, your mutual fund, your bond, if there's a profit on there. Now, the opposite is true with an IRA or a 401k, something like that the IRS has deemed either deferred taxes until a later date. You can sell inside there and not realize any capital gains because you're going to end up paying income tax later on that. You have to be careful when you're talking about capital gains. And then now when we talk about how it's taxed differently, as an example, you take money out of your IRA or your 401k, they're going to charge you federal taxes and state taxes, right? So it's income taxable. So whatever your rate is at the income tax, whether it's 12, 15, 22, 24, whatever those rates are now and what they'll change every year, it seems like, that's income taxable. Capital gains are not taxed at the same rate currently. If you're in the 12% tax bracket or less, you are not charged any tax on that when you realize it. If you're above the 12% tax bracket, you are going to be charged 15% on the sale. So again, I'll use the case that you made $5 after you made your stock. 15% of that is going to be taxable to the IRS. At the end of the year, you'll receive a 1099. Now, if you're in a higher earning income, I think it's something over 500, I think this year is 500 and some $1,000, you're actually going to be charged 20% taxes on your capital gains. Still much lower than your rate would be on income taxes, but still taxable nonetheless.
Inside those capital gains tax rates, there's a short term and a long term. Can you help us understand? And they're taxed differently in those two buckets. So can you just walk through and kind of, hey, what's a short term and what's a long term?
So short term and long term obviously has to do with the time frame that you're holding these. Anything held less than a year that you sell is considered short term. When it comes to taxes, this is going to be taxed as income taxable. It is not going to be at that smaller rate of capital gains taxable. Anything you hold a year or longer is considered long term. So all long term rates are at the capital gains rate. Anything less than a year would be considered income taxable to you. So you want to be careful when you buy something and you go to sell it for the profit that you want to make sure, is it a long-term or a short-term capital gain, so you know what your tax liability may be, again, outside of a non-retirement account. That's what's going to be taxable to you by the IRS.
So let's talk about, one of the things that you and I do when we're working on someone's non-retirement account, right, is a lot of times we're looking at the unrealized gains and losses and trying to use those to offset investments to prevent taxable events, right? Or to minimize the amount that is going to be taxed. So you just talk about a little tax loss harvesting.
Yes.
It's easy for me to say.
So yeah, we'll talk a little bit about that. So just on the side of you're being taxed on a profit, you actually are getting a little bit of a tax favorability if you have a loss. So like we talked to earlier, again, we have a $10 stock, it goes to 15, we sell it, we're going to have capital gains to pay. The opposite is true. If we bought it for 10, it's now at 5, and we sell this, we have to actually have a capital loss that we can use on our taxes. When I say use that, if you've had any of a sell of a house or sell of other securities and you made a profit, you can take that loss and use that, saying if I lost $100 but I've gained $100, at the end of the day when you do your taxes, you're going to show a zero capital gain. So you can use all your losses against all your gains each year. The one thing about if you have more losses than you have gains, as an individual, you can write off or use as a tax deduction up to $3,000 a year, which carries over until you use all your losses. So if someone had a larger account and they had $50,000 in losses in 1 year but had no gains to go against, theoretically, they could use that for almost 14 years of tax losses. But anytime they can use it against any of their gains to minimize taxable situations. So there is a benefit for what we do is called tax harvesting. When we are either rebalancing or if someone's taking money, we may look for some losses to use against some of the gains that we might sell. So yeah, you do get a benefit for losing. It's never good to lose money, but it is nice to be able to use some of that losses to help offset taxes.
Yeah. And the loss and the gain all need to be realized in order for them to offset on your taxes. So it's super important to understand that just because you have a loss in your account, it's not going to help your taxes until you realize that loss.
You're correct, right? So when everyone looks at their statements, they're like, I'm down $5,000. That is an unrealized at that point. Unless you sell, that's when it becomes realized. So you can only take anything you sell as a gain or a loss, either good for your taxes or bad for your taxes, but you actually have to sell it to realize either way.
Technically, in your account, when it goes up and down, those are unrealized.
Yes.
Right? So when people, get super excited about a gain or get upset about a loss, it's still unrealized.
Yeah.
Because that account's going to continue to move with the market.
Yes, you're exactly right.
All right, so real quick, we are not tax experts.
No,
right?
we're
We're
not.
talking about a tax-sensitive subject here, but
yeah.
We are not tax experts. We're always going to defer to CPAs, tax people to say, hey, what's the best? How do these apply? What do they? That's tax people.
Yes.
What we're looking at is from a gain-loss perspective in that account of trying to keep those to offset each other to keep your capital gains as low as possible.
You're exactly right. We are not tax professionals. We do not put ourselves as tax professionals. But like today, we're just trying to give a little bit more explanation on what capital gains, capital losses, how they're looked at, and things like that, because it can be confusing, right? I mean, these terms get thrown around, and with like yourself and mine, it just comes natural because we deal with it every day. But with the normal everyday person that doesn't, it can be very confusing. So we wanted to give a little bit of kind of a high level view of what a capital gain or a capital loss is.
Yeah, and we don't really want to get into it. There's a lot of talk about this in the current political environment. So we thought it was a great time for us to just say, hey, let's start helping people build their education on what capital gains are so you can kind of see through some of the shenanigans that you see on social media or just out there in general of what actually are capital gains.
Yeah, again, it is a hot topic going on. Obviously, we're in an election year, and keeping politics out of it, there's always changes in the tax laws. There's always changes in the investment, right, in the financial industry and every other industry regardless. So as it stands right now, what we're talking about is in 2024, what the taxable capital gains are or losses and what income tax part of it is. But those could change, and they have changed. Remember, it wasn't too long ago, maybe, I want to say 6 years ago, 7 years ago, I may be off a little bit. it was only a 15% across the board, but now we're up to 20 if you're over a certain amount of money that you make, right? So that, like I said, little changes happen a lot. So we want to keep up to date, but we really just want to give a high level view of what a capital gain or loss is and how it works.
Brent, you want to talk about some tax strategies that are related to capital gains, losses, any type of capital gain situation?
Yeah, one in particular that is currently in place, but seems to get attacked a lot each year by politicians is if you have whether it's a house, whether it's stock, some type of security, you have something that has a large amount of capital gains that are unrealized currently, you can actually hold on to that investment for your life. And when you pass, as the current law sits, that will pass to your heirs. And on the day of your passing, there will be a value put on that. And that's where your heirs actually start from. So I'll use it. We're in a farming community, right? We'll use this. So you have grandparents that have bought farm ground for $400, $500, $600 an acre, and they're getting ready they've just passed, and it's going to go to your parents, your father, as an example. We'll say the value of ground now is $10,000 plus. Well, that would be a huge capital gain if you ever went to sell it. Well, when they pass on the date of that, they will have a survey done, and whatever that survey says, that's the new beginning for your parents. So if, let's say it was $10,000, now they are at $10,000 an acre. Theoretically, they could sell it that day and have zero capital gains, theoretically. So as it stands now, holding on to something that's highly appreciated, if you're not planning on using it, could be a good tax strategy to save you from having to pay many taxes. And when your heirs get it, it's up to them then. If they want to, they could, again, theoretically sell it very shortly and have very little or no capital gains. So that's kind of a strategy we've seen some clients use with something they've had appreciate very high, especially recently, let's say real estate, a second home or farm ground, or maybe they had a stock that was passed to them from their parents and they don't really want to do anything and they don't want to cause any tax situation. They're going to hold on to it till they pass. And again, currently that still holds. I know historically, Congress has wanted to say, let's do no more estate taxes, but we'll eliminate the step up in cost basis. That's been shot down every time. And I would say, thankfully, especially for farmers. But yeah, right now as it stands, if you hold on until death, your heirs will get that stepped up basis for them.
One of the strategies we've seen used, there are several different types of strategies out there to be used. Consult your tax person to try to figure out what your options are and what best suits your individual situation. Anything else in closing you would like to talk about?
No, I think this high overview hopefully has helped someone understand a little bit of difference of realized versus unrealized capital gains. How am I taxed if I do it? Things like that. So again, we're not tax professionals. We're not putting ourselves out there as tax professionals, but you do need to be aware that there is potential tax consequences if you sell certain things.
Yep, for sure. Again, Brent Thoman, Brett Rice, Core Vision Financial Group, coming to you today with another episode in our video series, Capital Gains today. Thank you for spending some time with us. We appreciate your time. Thank you very much. Go to our YouTube page and subscribe so you're notified when we post new videos. Again, thank you very much.
Thank you, Brett.